Today, we're sinking our teeth into Tasty Bite Eatables. Now, on the surface, this company looks absolutely perfect. But the real question is this a delicious investment, or is it a recipe for disaster? All right, let's get into it. So at first glance, the picture is flawless. I mean, Tasty Bite makes those all-natural, ready-to-eat meals you see everywhere. And get this, they're owned by Mars, the huge company behind M&Ms and Snickers. Their products are on the shelves of big names like Walmart, Whole Foods, even on Amazon. And it's all coming from this massive 33-acre campus in Pune. So yeah, it seems like the perfect setup for a great company. But this is where we start to peel back the layers. So for our first section, let's talk about the American connection. Because once you really start to unpack their business model, a completely different story begins to take shape. Which leads us to this really important question. You see an Indian manufacturing hub, you see food that plays on that heritage, so you'd naturally assume this is a bet on India's amazing, booming consumer market, right? Well, hold on a second. It turns out that a whopping 70% of Tasty Bite's revenue comes from exports, and most of that is going straight to the United States. And that one little number, it changes everything. This totally reframes the whole investment. What you think you're buying is a piece of the Indian growth story, but the reality, you're actually buying a U.S. export business. Its success or failure is completely tied to the wallets and spending habits of American consumers. Okay, so now that we're looking at this through the right lens, let's dive into the financials. Welcome to Section 2, a roller coaster of profits. And believe me, this is where we start to see some serious cracks appear. Just take a look at their earnings per share. It's anything but stable. It's all over the place. Look at that massive 75% crash in fiscal year 22. Then it recovers a bit, only to fall off a cliff again in fiscal year 25. This is just not the kind of smooth, predictable growth you want to see as an investor. And if you zoom out and look at the last 5 years, the picture gets even worse. You can see their revenue, their total sales, has grown about 5%. Okay, not amazing, but it's growth. But their profits, they've actually gone down by 9%. Think about that. The company's getting bigger, but it's actually becoming less profitable. That's a huge problem. So let's move on to our third section, which I like to call red flags on the radar. This is where we uncover what are basically the smoking guns of some serious governance and value problems. One of the biggest red flags is the revolving door in their boardroom. I mean, check this out. In just 4 months, a non-executive director, a food service director, and even the chairman all resigned. When you see a rapid-fire string of high-level people heading for the exits, it really makes you question what's going on with the company's stability. Now, to really understand this next point, we need a quick primer on a metric called Return on Capital Employed, or ROCE. Put simply, it just measures how good a company is at making money from the money it invests in itself. Now, for a company to actually create value, that ROCE number has to be higher than what it costs them to borrow money. And here is the absolute kicker. Tasty Bite's ROCE is about 10.7%. But what it costs them to get that capital is around 15%. This means they are actively destroying value. It's like taking out a loan at 15% interest and then putting that money into an investment that only pays you back about 11%. You're literally losing money on every dollar you invest in the business. So when you put all of this together, we have to talk about risk versus reward. So in Section 4, let's weigh the potential outcomes. What could the future actually look like for this stock? Analysts have laid out 3 possible scenarios. In the best case, the bull scenario, the stock could maybe go up 21%. But look at the base case, which is just a gradual recovery. That still points to a 24% loss from today's price. And the bear case? Well, that's just downright scary. So let's isolate that upside for a minute. In the most optimistic, everything goes perfectly right scenario, your potential gain is a pretty modest 21%. Just keep that number in your head. Because now, here's the other side of that coin. The potential downside if things go wrong is a catastrophic 70% loss. I mean, when you weigh a potential 21% gain against a potential 70% loss, that risk-reward balance looks really, really bad. And all of this brings us to our final section, the final verdict. It's time to assemble all the pieces of this case and see where we land. So to sum it all up, the verdict from the research is a very clear avoid. Why? Well, that risk-reward is just terribly skewed to the downside. The company is literally destroying value with its investments. You've got major red flags in the boardroom, and on top of all that, it's trading at a really high valuation, even though its business is completely exposed to the whims of the U.S. market. So, after this deep dive, the investment case for Tasty Bite just seems far from delicious, especially at its current price. Which really brings us to our final question. What company should we put under the microscope next? And hey, that's where you come in. If you want more deep dives like this one, please subscribe, like this, and definitely press that bell icon. But most importantly, let me know in the comments which listed stock in the Indian stock market you want me to analyze next.